Are you overwhelmed by the constant noise in the markets, daily headlines, sudden volatility, and endless expert opinions? Curious to know if there's a way to rise above the chaos and make smart investment decisions? Then joining us today is our financial expert, Mr. Ramalingam. Mr. Ramalingam, can you walk us through this?
Then what is the source of peace? From where, as an investor, I can get peace? I understand I should not rely on trends. I should not rely on simple headlines. I have to go beyond headlines. That part we are very clear. So how do I get peace what gives you peace is process. When you have a right process that is created based on principles of timeless investment wisdom, then you need not worry about it. Investing is not just about profits, it is also built through the process. If you are able to master the investment process, profit will be the byproduct for you. If you have a process, that process will discipline you, that process will be a strength to you even during noisy market. So I told you process should be based on principles of timeless investment wisdom, correct? Anything which is a timeless investment wisdom, anything which is timeless is basically boring, right? Consistently, every day study, you will score good marks. Every day do your workouts, exercise, you will become fit and healthy, right? This is basically boring advice, but timeless advice. It works. Similarly, what is going to be the boring investment principles, timeless investment principles? Obviously, all these things are boring, must be already knowing. I will not going to spend much time. The basic things like you have to create an emergency reserve for 6 months of expenses equivalent money. Should be short-term money, fixed income. You should not risk your short-term money in equity. You have to invest money in equity, 7 year plus money in equity. You should not invest your long-term money in fixed income schemes. It will not beat inflation. These are all powerful investment advice, powerful investment principles. But I'm saying boring investment. Don't invest in everything at one go. Invest in a staggered manner, SIP kind of investment. Don't invest everything in one basket. Invest in multiple baskets. Invest in equity, fixed income, gold. Even in equity, invest in large cap, mid cap, small cap. Right? So there are multiple methods by which we invest. That we have to be very clear. So all these basic principles we already know. But when we create a process based on these principles, how will it help create wealth? How can we mute noise and settle with peaceful investing? So I'll give you classic examples people have asked me. In July, August, September 2024, in that quarter, market was at peak. It was moving from 80,000 to 85,000 levels, Sensex. That point in time, people were asking, can I withdraw my emergency money? I have kept 6 lakhs as my emergency money. It is simply sitting in liquid fund. It is giving me only 5 to 6% or 6 to 7%. Whereas in my portfolio, small cap has given 30% return. Can I switch this emergency money to small cap? Simple. But the same investor, if they could have done it, they will regret. Most of the do-it-yourself investors who have done it, who had emergency money, they have invested in small cap and they have suffered. That is why all those small cap SIPs got stopped when the market, we see in the news, total SIP counts are coming down during last 6 months. It's all because wrong money that got invested, unhealthy money that got invested in stock market. Unhealthy money is you have money for emergency, but you have kept it in small cap. It is obviously an unhealthy money in stock market. When the correction happens in the market, correction happens also in your portfolio via, you will move your emergency money, which you have wrongly invested in equity, to fixed income. You realize the mistake. It corrects your portfolio also. So that's what correction. Emergency money. When an investor asks me, I tell them, boss, as per process, you are supposed to keep 6 months of expenses equivalent money in liquid fund. It should not be invested in any equity fund at any point of time when the market is going up or the market has crashed and it is going to recover. No, you should still keep your emergency money liquid fund or fixed deposit only. That is the principle, that is the process. Similarly, people have asked me, like I have some money kept for my daughter's wedding or education just 2 years from now, 2.5 years from now. Market is doing well. I'm seeing 20% plus returns. Can I invest that money in equity? The answer is simple. Based on process, it is simple. That is why, like, when someone approaches us, we don't immediately recommend schemes, right? Some of the clients could have seen, like, ask me, Ramling, I have 5 lakhs to invest. Can you tell me where to invest? No, boss, like, we have to review, look at the portfolio and see where are we heading. Accordingly, we have to create a blueprint. We have to do a process, right? Where are you now? Where you need to go over a period of time? What are the financial goals you have got? To achieve those financial goals, what is the journey? How much to invest in equity? How much to invest in debt? When you have to move out of equity? When you have to increase your debt exposure? All the process. When you do that, this question, like answering this question, why am I in fixed income debt more and the equity is doing well? Because your process says you have to invest your short-term money only in fixed income. And also we have an asset allocation ratio 70-30 for somebody, or 80-20 for somebody, or 60-40 for somebody. Suddenly when the market in the bull run, people become slightly more confident and ask a simple question. Sir, can I increase my equity exposure from 70% to 80%? During bull market, don't do it. Because your asset allocation is based on your risk profiling, based on how much long-term money you have to invest. Now, when you have to change your asset allocation, it has to be again based on reassessing your risk profile. Just because in the last 1 year equity has given good returns, you should not increase your equity exposure. Then now market reverses, market has gone down, and there are a lot of negative news about small cap. Now people are asking me, can I switch out of small cap for time? Can I invest more money in large cap or gold? So can we withdraw money from small cap? So in your overall big picture, how much money has to be invested in equity? In that equity exposure, how much money should be allocated to small cap? Let us say 20% has to be allocated to small cap. That is what, as per process, we should have allocated. If there is no process, that investor would have seen small cap is giving very good return. He has invested everything in small cap. Now he is under risk. Now he has to, because it has come down considerably the last 6. It has not clear. There's a 15% gap even now in small cap. So if you have invested all your money in small cap, then you are under risk. When you have given only right allocation to equity, and within equity right allocation to small cap, this is where process helps. Process will not allow you to take any wrong decision. Process default will mute the noise. It will avoid you from taking wrong decisions. Markets are volatile. Can we stop SP? Can we start SIP in gold? No. As per process, you are supposed to continue your SIP. Only if you continue your SIP in equity, it will continue to deliver 12 to 15% in the long run. Only if it continues to deliver 12 to 15% in the long run, you will be able to meet your retirement goal. You will be able to meet your kids' education. Right. Similarly, like gold, you can invest in gold as per your astrology. In your overall portfolio, if you have given 5% allocation to gold, just continue with that. Don't increase it or decrease it just because gold is falling, just because gold is going up. Don't do it. So, whatever we have discussed, suddenly somebody wants to invest more money in small cap, somebody wants to stop investing in small cap. It's all because of two fear. One is fear of missing out. In 2023-24, small caps were doing well, so people want to invest more money because they don't want to miss out. Fear of missing out. Now, small caps are falling down. Can I withdraw? If I continue to stay invested, what will happen? I lose money. So fear of losing. These two, fear of missing out and fear of losing out, are by noise. If you mute your right process restrict you from taking the wrong investment decisions. Just because of the temporary mood, you will not take any long lasting negative decisions. You will not be able to take. That is the process in place. With right process and plan, you'll be able to face the market crash with a lot more process. Invested all their money last 1 year IPO. When the IPO got listed, it would have given them reasonably good returns, but that portfolio now is hurting them deeply, bleeding, because they simply chased IPO. They simply chased a small cap portfolio. They didn't keep emergency money. They didn't keep short-term money in fixed income. All those people are suffering. That is why, you have to practice peaceful investing with the right process.
Thank you for your detailed answer. If you have any doubts regarding this or any other financial decision, don't hesitate to book an appointment with our financial experts. The link to the appointment is given in the description below. Also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. Link to the webinar is given in the description below, and the webinar is absolutely free. So if you like this video, hit like, and if you're new to our channel, please do subscribe. Thanks for watching.